Investors, beware of this risk before you invest in real estate. In this video, I will share with you my 5 top dangers of investing in real estate and how to avoid them. Not knowing this risk when I started cost me a lot of big bucks. Today, I'm here to share my experiences so that you can avoid losing big cash like I did. Let's go. Any type of investing requires you, as the investor, to understand the risk versus the returns. And real estate is no different. The truth is, you can mitigate most of this risk. That means you can select the real estate investment that have very low risk. In that way, you'll be controlling your investment. And obviously, you'll be exposed to higher upsides and the chances for you to make a lot of money. Sometimes, real estate can feel like a roller coaster because you know what? Number one, it got some huge major market risk. Many investors, including myself when I started, wrongly believed that real estate market could only go in one direction, up. Don't get seduced by a sexy looking burden or great projected returns. All markets have ups and downs tied to the economy, interest rates, inflation, and other market trends. And unforeseen events all play a role in real estate trends. We, as investors, cannot eliminate market shocks, but we can hedge our investment against the booms and busts with a diversified portfolio and strategies based on general market conditions, coupled with careful research, due diligence, and monitoring of your real estate holdings. What you don't know can hurt you. Who knew that a deadly virus called COVID-19 was going to happen in 2019 and the market was going to get hit due to the aftermath? I took about 30% knock on my rental income due to COVID rent defaults. But because I invested in desirable areas, coupled with the fact that I made a vow not to leverage more than 70% of my property investment at the beginning of my investment career, I was able to navigate the storm. This leads me to point number 2, choosing a bad location. Have you ever heard the saying that real estate is about location, location, location? But you cannot choose a good location without first identifying what your investment needs are. So this is what happened to me. At the beginning of my property investment career, I bought into an area that offered the potential for capital appreciation. But my actual need was to get a higher return on my rental income. The stupid me thought that I could create higher rental in an area that was renowned for high capital appreciation. So the lesson learned here is, don't look for the needle in the haystack. Just buy the haystack. After all, you can't move a house to a more desirable neighborhood. Nor can you move a retail building out of an abandoned mall. So where is the asset located? And what is happening around the area to make it a good investment? The location ultimately drives the factors that determine your ability to make a profit, but it has to be linked to what your investment needs are. Number 3, negative cash flow. Cash flow on a real estate investment is the money that is left after paying all expenses, taxes, and mortgage payments. Negative cash flow happens when the money coming in is less than the money going out. That means you are losing money. Let me demonstrate this to you. As a new investor, you may be so happy and desperate to get into the real estate business. And so, you decide to break a few rules by not applying the 80-20 principle. And you therefore go to buy a property for 200,000 rand. Your effective monthly expenses is 2,500 and your monthly rental income is 2,000 rand. So your net cash flow will be negative 500 rand. Let me ask you a question. Who is paying that 500 shortfall? Rule number 1, if you are going to invest in real estate, buy smart. Make sure that after all expenses are paid, the rent coming in are not equal but more than the expenses. The best way to reduce the risk of negative cash flow is to do your homework before buying. Take the time to properly screen your tenants. Avoid too much maintenance and high financing costs. Make sure the property is in a good location. The 4th top risk of investing in real estate is liquidity risk. You might be asking yourself, Echo, what is liquidity risk? Well, according to Investopedia, liquidity risk occurs when an individual investor, business, or financial institution cannot meet its short-term debt obligations. The investor or the entity might not be able to convert an asset into cash without giving up capital and income due to lack of buyers or an inefficient market. Taking into consideration the depth of the market and how one will exit the investment needs to be considered before buying. An investor can expect dozens of buyers to show up at a bidding table in places like Sandton, Kibla Park, the south of Johannesburg, regardless of the market conditions. However, a property located in JP or Berea will not have nearly the same number of market participants, making it easy to get into the investment but difficult to get out because of the lack of liquidity. You could end up selling below the market or at loss if you need to unload your property quickly. While there's not much you can do to lower the risk, there are ways to tap into your property's equity if you need cash. Watch my video on how to refinance your property. For example, because I don't leverage more than 70% on all my investments, I can take out a homeowner's equity or do a cash out refinance instead of being forced to sell at a loss when the need arises. The fifth top risk of investing in real estate is problem tenants. Every landlord's major challenge is getting and keeping good tenants. If you can meet the challenge of picking good tenants, you will preside over a smooth running operation and rent will be paid on time. There will be a cordial relationship, low turnover, and minimal vacancy factor. If you're already a landlord, I don't have to tell you what an undesirable tenant is. You will discover problem tenants comes in two major categories. Number one is the inconsiderate slobs, the one who is dirty, filthy, and messy, and leave all sorts of visual and bad smell experience in the house. Number two, irresponsible deadbeat, someone who won't pay their rent when due. I'm not talking about late payers. I'm talking about the one who doesn't pay at all. Don't make the same mistake I made when I started my career by accepting tenants on face value. Be sure to run a credit check and a criminal background check on every applicant. Also, contact each applicant's two previous landlords to look for red flags like late payments, property damage, and evictions. And if you can, visit the prospective tenant's current apartment or take a look in his car, and if the inside of the car is trashed or unorganized, chances are same will happen to your property and they won't pay your rent at all or on time. Now, for those who have a problem tenant, in spite of all precautions, always remember that money is the problem 95% of the time. Maybe offer to pay his moving cost. There is something you can do before going to court. You can visit your tenant and you'll be surprised how often this works. Appeal to his sense of fair play. Tell him that things aren't working out and you would like him to move out. Ask him how much time he needs. In many cases, a very reasonable approach works. You'd be surprised what you will get by just asking politely. The bottom line is, real estate is not a set it and forget it investment. You should monitor your investment and adjust your entry and exit strategy as needed. Having frames of references for investors to quantify risk helps ensure that your investment matches your needs, goals, and tolerance. At our PropertyAskEkow Masterclass, we use sophisticated risk models and the deep knowledge of our acquisition team to account for the many variables involved in evaluating the potential returns of a new property. Call or WhatsApp us now for your free 15-minute consultation. Until next time, bye-bye. But we can hedge our invest, but we can.